We're here to talk about the Silicon Valley real estate market ending the week of October the 24th, presented on Saturday morning, October the 25th. These are the key chapters that are in the YouTube description below. You can jump to the chapters you find most interesting. There's a brief description and the associated graphics over here and the chapter number so you can find your way through. Overall presentation about 45 minutes long. Let's get into it. Here is the first summary slide. We're looking at inventory, and what we're doing is we're looking at the past 13 weeks to the left of the center of the graph. That's the historical data ending up with this current week, going back to 13 weeks ago. We also go with the trend data because I look at what I'm comparing it to the 10-year median. So the 10-year median is available for future weeks. And what it does is it shows you where the inventory is right now. You're basically right on top of the gray line. So you're normal. You're 103% of normal, essentially normal. And you expect inventory to start falling off as we get into the end of the year. And so far, that's what we've been doing. We've been following the normal trend. We were 13 weeks ago, 102% of normal. So we've gained 1%. That's just in the noise level. I consider within about 12.5% of 100% to be a perfectly normal marketplace. And then if you're interested in raw count, we have 2,633 active listings in Silicon Valley, which is made up of Santa Clara, San Mateo, and Alameda Counties. Doing the same thing with offers accepted. Slightly different story here. We're currently only selling 80% of what we typically do. So we're missing 20% of the marketplace. But you can see that we've been right on the blue line for quite a long period of time. And actually, the last couple of weeks, we are above that blue line. And 2 weeks ago, we were actually at 85% of normal and looking pretty good. We've now lost 5% over the last 2 weeks. But again, you can see that we drift off a little bit up through Thanksgiving, and then we drip off more through the end of the year. And that's as far as the number of offers being accepted. Closed transactions is what the industry runs on. This is actually transactions where they're successful in closing. You can see that we're selling currently about 83% of what we normally do, a little bit above offers. They're not going to be ever in sync because they're two different numbers. The TFT ratio falls, and there's about a 3 to 6 week time lag between offer accepted and transactions closing. Days unsold inventory is the seller-buyer balance, the supply-demand balance. It's sort of a very key indicator in free economy. You can see that we're 112% of where we normally are, so we're above the gray line, which is a slower marketplace. Blue is always favoring the buyer, a slower marketplace. Red is favoring the seller in a red-hot seller's marketplace. You can see that we've improved from 13 weeks ago when we were at 135% of normal, both on percentage basis and magnitude. We were slower at 54 days to sell out your inventory. Now we're only at 45 days to sell out your existing inventory. An easier to understand metric is the days on marketplace. And this is how long is it taking 3 out of 4 sellers to sell their properties. Now, one of the big differences between days on sold inventory and DOM is DUI, days on sold inventory, is a theoretical number. It's how long it would take to sell the existing inventory at the existing rate of sales if no new inventory came on the marketplace and the rate of sales didn't change. So it's theoretical, it's a turnover rate, but it includes the sellers that are trying to sell that are not successful, where marketing time only includes sellers that were successful in selling. So we're not including the sellers that came on the marketplace, tried to sell, and went off the marketplace without selling because they didn't sell, so you don't know how long their time on the marketplace would have been. So two different metrics that are measuring similar things. You can see that we're at 8% above normal, 108%. A quarter ago, we were at 170%. So we've improved fairly dramatically on a percentage basis. We've also improved on a performance basis. We went from 5 weeks, 35 days, down to 4 weeks at 28 days. So the market's been improving, and you can see that the change really happened about 5 weeks ago, 5 to 4 weeks ago. You were basically at the blue line, and then you came down and you were quite a bit closer to the gray line, and then you gradually improved. In the last 2 weeks, we've been sort of doing the same direction as the gray line, with a little bit more duration and time on the marketplace than you would expect based on the past 10 years. And I use the median for the past 10 years. Price reductions. These are the price cuts that the sellers take after they come on the marketplace and they're not able to entice the buyers to give them an acceptable offer. This again only looks at the sellers that are successful. We don't look at price cuts of active listings, but we look at price cuts of those transactions that have gone into escrow. So this is an overly optimistic read of the marketplace if you wanted to get an overall market reading. We're at 40% more than you normally are, it's just coincidental, the numbers were identical. So that right now sellers are taking 1.39%, just shy of 1.4%. And normally they're taking 1%. So that's 1.39% more of a price reduction than they normally do. And you can see that you're on the blue side of the gray line. So you take larger or more frequent price reductions than you typically do by 40%. Again, the magnitude is fairly small. Normally you're only taking a 1% price reductions. Now you're taking a 1.4% price reduction. I will also mention that the vast majority of the successful sellers do no price adjustments whatsoever. They come on, it's typically never more than about 25% of the sellers that are doing price reductions, and the numbers normally between 15 and 20%. And that's because sellers with their listing agent do fairly good research before they put their house on the marketplace, and they come on the marketplace at the price they expect to sell. Overbids is actually a lagging indicator. It tells you how much competition the buyers are feeling in order to try to secure the property. A quarter ago, the overbidding was 3.8%. Typically, it's 6.5%. So you were about 3% less overbidding than normal. Now we're at 5.1%, where you're normally at 4.9%. So you're actually 0.2% more overbidding in magnitude than you normally are. And unlike price reductions, overbidding is widespread. Currently, and I haven't looked at the data yet, about 55% of the sellers are getting more than their asking price. So overbidding is widespread. Price reductions are actually a fairly small segment of the marketplace. Now we're looking at the three key indicators over a long period of time. In fact, we're going back about 11 years. 10 years that I use for the history starts on January 1st, 2015, ends on January 1st, 2025. Those are the 10 years that are used. The last 2 years, 2024 and 2025, are in the expanded X horizontal dateline axis, basically 2X, so that you can see trends better. You're looking at inventory on the purple line, and you can see that you were surplus inventory earlier this year, and basically record high surplus. And the only other time that you were in this level was right at the end of 2018, going into 2019, and that was in part triggered, especially in Santa Clara County, by 2017 having a double appreciation year, causing 2018 to slow down a little bit. So inventory is floating around about 5%, 4% more inventory than you typically would expect. Offers is down here, and we talked about 80%. Well, actually, a few weeks ago, we were back up at 90%. I think I commented about this little bit flip up where we were at 85%, but we got all the way up to 90%. And you can see since the pandemic, we were initially missing 30% of the market. Then we were missing 20% of the marketplace. And this year and it may have been closer to missing 25% of the marketplace. And this year we're missing about 20% of the marketplace. So we've gained about 5% a year, but this year has been more cyclical. There's been more variation than there was in 2024. 2024 was a flatter line. Here you have more peaks and valleys. It just shows that every year is a little bit different. And that's one of the reasons I use a 10-year median, is to try to get rid of those fluctuations that we have. And lastly, we're looking at the DUI, the gray line up here, which actually is probably the more important because it's a supply-demand balance. You can have a lot of supply as long as you have a lot of demand, or you can have little demand as long as you have little supply. So it's really the ratio between the supply and the demand that indicates the health of the industry. And it depends on what you're measuring by the health. If you're talking about the industry itself, it would love a lot of transactions. But as far as the buyers and sellers are concerned, as long as they're able to find the property and sell their property, what they're more concerned about is the speed of the market, the ratio of the marketplace. And here a high number is actually bad. You can see that we came down. We were at 100% just about 2 weeks ago, and we're now back up to about 112, maybe even 112.5% of normal. So we're 12% slower than we normally are for this time of the year based on the past 10 years. Now we're looking at each individual component of the marketplace, and the first one we look at is inventory. Here you have the same concept. The purple is the data line, the gray is the 10-year typical, red is a red hot seller's market, which would be a lack of inventory, and blue would be an ice cold buyer's marketplace, which would be a lot of inventory. You can see that we're right on the gray line. We're slightly above it, not significantly. You can see the period of time early in, well, let's take all of 2025. We started off with a shortage of inventory. We rapidly came up to normal level of inventory. Then by the end of first quarter, we actually had a surplus of inventory all the way through second quarter. Then in third quarter, we came back down in the first half, rapidly approached the normal. We spent the second half of third quarter right on the gray line. And now in fourth quarter, we're slightly above the gray line. Here is on a percentage basis. This helps you see trends. You can see the peak surplus inventory here, and the only other time that we had that was at the end of 2018 going into 2019. Different time of the year where you had the peak, but the peak's roughly the same magnitude. And this peak was sort of Santa Clara County only. This peak is more all three counties. Here's now looking at the number of offers accepted. You can see you're right on the blue line. You've been on the blue line basically ever since the 2022 price correction. So here's the 2022 price correction. Here's July of 2022. And ever since, we've been basically following more or less the blue line, which is the least amount of sales activity that you would expect based on the past 10 years. Here's on a percentage basis. Here you can see that you were 30%. Here you can sort of see you're floating on both sides of 25%, and now you're floating on both sides of 20%. So we're regaining a little bit of that transactional volume each year, or at least that's what's happened the last 3 years. And you can see the surplus of transactions that we had right after the pandemic. But the surplus that we had was, roughly 20%, and it was only for, 1 year, 2 years. And now we've had a decrease of about 25% for 3 years. So we've more than given back the surplus number of transactions with a lack of transactions over the last 3 years. Here's the days unsold inventory. You can see that we were above the blue line for the first 3 quarters of this year, and only now the second half of third quarter and in the fourth quarter are we essentially approaching the typical normal line. Here's days unsold inventory compared to normal. So here's where you can see the speed. And here this year in 2025, we were actually slower compared to what you'd expect it to be than we were any time in the past 10 years. And that was about this middle of second quarter, which was the peak of the marketplace as far as slowness. Now you can see we came down, we got to 100% when we slowed down. We did one other tighter bounce back here, which is probably associated with a little Labor Day. Each holiday negatively impacts real estate, and the bigger the holiday, the bigger the impact. With Labor Day, it moves around because it's a Monday holiday. And so over the 10-year median, the impact of the holiday actually shows up in 2 of my week's data, where in any given year, it only shows up in 1 year, which is why you have the spike. And you see it also happened back here on Memorial Day, and it doesn't happen on July the 4th because July the 4th is a date-sensitive holiday. Here's marketing time for the 75% of the sellers compared to normal. You can see that we were selling more rapidly than normal at the beginning part of the year. We rapidly crossed over and got up in these high numbers here where we were taking longer than normal to sell. And basically right at the end of the quarter, about 2 weeks before the end of the quarter, we did this huge improvement. We came down to the normal level, and now we're following the normal trend and we're going up as we normally do at this time of the year. But marketing time right now for 3 out of 4 sellers is essentially right on the normal curve. Here's on a percentage basis. You can see that we're actually a little bit longer than normal, about 108%, so 8% longer than typical. But that's just in the noise level again. You got a lot of noise. Statistics, you got to pay attention to what's noise and what's real data, because you can get factual data that's accurate, but if you rely on it too much, you're just making trends up that really don't exist. Here's price reductions. This is my favorite of the price reductions. And this is the largest, the 90th percentile seller, the seller that's taking the largest percent price reductions, but not on the total extremes, is taking a 14% price reduction. That's pretty significant. If you're talking about a $2 million median priced home, that's $280,000. So you're not talking about small numbers here. So it's only the next numbers that we're doing. And here is based on normal. So this is compared to the 10-year typical. And you can see that we're taking 20% more price reductions. And we have been taking more price reductions. Basically, here's the price correction starting in middle February of 2022. Look how rapidly you went from basically no sellers taking a price reduction to basically 160% more than normal. And now this year, we didn't get that high. We only got to 140%. And right now we're at about 120%. This is actually magnitude because this is the 90th percentile. So you're looking at the sellers that are taking the seller that's taking the largest price reductions, how big is that price reduction they're taking? Here now is the average price reduction. So this is on here more because this would be a more quoted normal number. Normally people don't look at 90 percentile. In fact, statisticians typically look at quadrants, 25%, 50%, and 75%. I like looking at the more extremes because it gives you an idea what's happening. Also, when we look at price later, to be able to say that 80% of the homes in this area are between these 2 price points is way more significant than being able to say 50% of the homes are between the 25th percentile and the 75th percentile. And if you're only having 15% of your sellers reducing your price, looking at the 25th percentile, you're adding in a bunch of zeros. And it is not uncommon at all to have 15% or fewer of the sellers doing price reductions. So anyway, on average, that 14% price reduction that we were talking about for the largest turns out to be about 1.4%. So on average, the number is fairly small. That 140,000 or 280,000 in my example becomes $28,000. So a huge difference, an order of magnitude difference when you look at average. Here's compared to typical. So we're getting back up into that typical range. You can see we were taking larger price reductions. We were taking bigger price reductions this year, and bigger than any other time other than the 2022 price correction and the 2019, which was the leftover for the 2017 and 2018 price thing that I talked about earlier. Here's the frequency. So how common is price reductions? You can see you were right up on the blue line, and right now you're down approaching the gray line. So we're almost having the normal level. What level is that? Right now it's at 19% of the sellers are doing price reductions. So 4 out of 5 sellers in Silicon Valley are not doing a price reduction. And you can see the biggest we ever got to is 35%, which is basically 1 in 3 sellers. So 2/3 of your sellers do no price reductions. Here's compared to normal. And again, right now you're about 115% of the level of price reductions you'd expect, with it being 15% more common than normal. Here's the overbidding. So now we're flipping over and we're looking at what the buyers do. This is also a lagging indicator because I need sold price. So it's 3 to 6 weeks behind. In a slower marketplace, it's more like 4 to 6 weeks. In a faster marketplace, it's more like 3 to 5 weeks. So it does move, and it varies from transaction to transaction. So right now you can see earlier this year, we were taking very little overbidding at 100%. And now we're basically at about 101.5%. This is the median. So half the buyers are overbidding more than this and half are overbidding less than this. The numbers that we saw earlier in the presentation, that 5.1 and 4.9 numbers, that was the average. The average is going to always be higher than the median. The median is the midpoint. So half the buyers are above 1.5% over ask price, half are below. Here is compared to typical, and right now we're very close to the typical level. If you were at typical, you would be right on the 0 line. So we're a little bit overbidding. I think the numbers were 4.9 for typical and 5.1 for the actual purple line. Here's the frequency of overbidding, how common it is. I was a little low on my estimate earlier. I think I used 55%. We're actually just over 60% of the sellers are getting more than their asking price. So 3 out of 5 sellers are getting more than they're asking for their properties. Here's on a percentage basis. So that's 90% of what you'd expect. So normally we'd be having about 66% of the sellers getting more than their asking price. And right now we're about 60%. Here's 2 different pricing models. This 11.4% is beginning more and more unrealistic. If you say we went up 12.1% for 7.5 years, and then 0% appreciation for the last 3.5 years, that's a fairly accurate model. You probably did have a little loss of value at the end of 2022 and then early into 2023, but it was only a year span of depressed prices. And then you came back up. These ups and downs that you're seeing, that's partially product fluctuation as well as fluctuation during the season. Notice how the peaks are all coming at roughly the same time, usually sometime during second quarter. Here's a summary of the micro market areas. You start off with the green areas over here. These are all compared to the 10-year median, and then these are the raw counts. And you have Santa Clara County on the top, you have San Mateo County in the middle, and Alameda County in the bottom, and the different cities that make up the areas. And then in the case of Santa Clara County, because San Jose is so big, the different regions of San Jose. But the big takeaway, there's an awful lot of blue here. So the marketplace is slower than it normally is. But if you come over and look at the raw numbers, it's pretty mixed. So even though it's slower and more favoring the buyer of Silicon Valley is than it typically is, it's still a pretty aggressive marketplace. There's a fair amount of overbidding, as you can see here. In fact, if you eliminate the coast, there's not very much blue at all. You know, the blue is the San Mateo County coast is the bluest, the coolest overbidding. But if you come back and look at price adjustments, they're not necessarily more common because there's as much red as there is blue. But the average, the magnitude of the price reductions is great, is favoring the buyer more than it normally does. But marketing time and days of unsold inventory are completely balanced. To sell 3 out of 4 sellers to sell in 3 weeks for a good part of Silicon Valley, that's fairly fast. A good part of San Mateo County is selling in 3 weeks, and Alameda County is selling in 4 weeks. I mean, that's a reasonable marketplace and probably fast. and buyers would not be overbidding if they weren't feeling the pressure out there. So what I'm trying to convey is, yes, the market is slower than it normally is by a little bit, but it's still a very fast-paced marketplace. You're basically hot versus super hot. Here now is looking at each one of the different metrics. We're looking at active inventory. You can see that the graph is pretty white in color. You got a little bit of pink here where you have a shortage of inventory right around 80%. And if you go over to the coast, you have a little bit of surplus where you have 33% more, 37% more than inventory than you normally do. And even Foster City, which is a very small micro marketplace, has almost 50% more inventory than it could be. But if the inventory just came on this last week, it would count as inventory, and buyers haven't had a chance to buy it yet because, like in general, Foster City and Redwood Shores has been a hot marketplace. So that very well could be what's going on. Here's offers compared to the 10-year median. Here you can see the shortage. Rough numbers, I'm talking about 80% overall. In fact, you can see Silicon Valley is at 80%, Santa Clara County is at 81%, San Mateo County is at 94%, and Alameda County is doing the least well at 76%. And I don't have micro market data for the first couple slides for Alameda County. Days unsold inventory, this is their theoretical turnover rate. You can see that we're compared to the 10-year median. You can see Santa Clara County is basically normal. You got some areas like Los Altos at 90%, which is faster than normal. And your slowest area is Milpitas at 22%. So it's slower than normal. Los Altos and Palo Alto is faster than normal. Milpitas is slower than normal. In San Mateo County, the range is a little bit, well, I'm going to ignore Foster City because, again, I suspect that there was an influx of more listings than normal this last week. And next week, these numbers could be fairly significantly different because if you ignore that, you go from a high of 38% longer days unsold inventory to a slight shortage of 2% faster than normal. So pretty close to normal. And then Alameda County is basically 23% slower than normal, longer than normal for turnover rate, which is the theoretical turnover rate. Here's the actual raw numbers. So even though Alameda County was slow, you have areas like Hayward, San Leandro, and San Leandro that's selling in 37 days. Fremont is in 25 days. Oakland, Berkeley is at 40 days, basically, then 70 days. So you have a fair number of areas that are fast-paced moving, but you also have some slow areas, 160 days for Dublin, Livermore, Castro Valley, 140 days for Pleasanton. Here's marketing time. So this is actually for the successful sellers. How long are they taking to sell? You can see you have areas like Milpitas that are selling in 3/4 of the time. So they're selling quicker. And I think their turnover rate was actually longer. So that would tend to suggest Milpitas is having some unsuccessful sellers. You got red area up along the east foothills up in Alameda County, and you got a fairly balanced marketplace on the valley floor and on the West Peninsula area. Here's the actual marketing time. So how long is it taking to sell? Well, you got some areas like Saratoga, Las Gatos at 57 days, which is a little bit, and Saratoga, Las Gatos tends to be a longer marketing time. But look at most of Santa Clara County, 16, 17, 20, 22 days, 32 days. The only time that's really and it's also typically a longer marketing time like Saratoga, Las Gatos is South County at 53 days. So your two slow micro market areas are becoming slow again, and the rest of the county is moving fairly fast. If you look at San Mateo County, you have three regions that are at 3 weeks at 22 days, one at 24 days, and two at 7 weeks. I mean, that's fairly fast paced. Alameda County, sort of the same range, 19 days to a long of 35 days. So Alameda County is actually more condensed than the other counties. Here's price reductions compared to normal. Now, granted, except for the San Mateo County coast, price reductions are blue in color, so they're more common and they're in negative numbers, so they're lower than normal. So the magnitude of price reductions are greater than they normally are. Here's the average magnitude. So you can see this is actually converted to price reductions. You can see the highest number I'm seeing is about a 2.7% price reduction in the East Central and South San Jose, 2.6% in Saratoga and Los Gatos. So your most affordable and one of your least affordable areas are having the same large price reductions, as well as also South County having large price reductions. Menlo Park Atherton is having 4.2%. That's absolutely the biggest. Look how deep blue that is. That's going to be saturated blue. The areas that are having the least price reduction, Foster City at 0.1%. Here's the frequency of price reductions compared to the 10-year median. You basically are right at normal for a lot of areas. The third more price reductions in Morgan Hill through Central San Jose. San Mateo County, 420%, so 4 times more price reductions. That's almost hard to believe for Foster City. But again, it's such a small micro market area. I bet you there's not even a dozen homes in that micro market area. So the data does fluctuate quite a bit. What I try to do on these micro market areas, I try to put in contiguous areas that the properties are similar in price and marketing times and characteristics of the marketplace. Areas where the buyers are going up and down. A buyer, would not typically look in just Campbell. They'd look in Cambrian, Santa Clara, and Willow Glen. A buyer in Cupertino would also usually go over and look in Sunnyvale. So I try to use my market knowledge and market research to group similarly acting properties together to get to the micro market areas. So there's multiple zip codes in each one of my micro market areas. I think there's 100 zip codes roughly in Silicon Valley that I track, and I only track 20 micro market areas. So each micro market area, if it was on average, has 5 zip codes in it. There's going to be some that have more. There's going to be some that have less. Saratoga, Los Gatos is only going to have, it might have 3 zip codes in it. Redwood Shores and Foster City probably only have 2, and they're probably 2 small zip codes. So this is the frequency of price reductions. You can see that you're on both sides, but I would say that frequency of price reductions are favoring buyers a little bit more. There's more blue tint, like Silicon Valley here is a little bit blue. San Mateo County is more blue with 1 pink, and Alameda County is more blue with 1 pink. Here's the ask price frequency. So how common are price reductions? These are raw numbers. So even though it's more frequent, they're still not that common. Getting a little bit common in South County at almost 40% of the sellers are doing price reductions, 30% in the affordable areas, 26% in Saratoga, Los Gatos. The expensive areas in San Mateo County at 35%, the coast at 30%. You go down to Alameda County, and the highest number I'm seeing there is about 25%, and a good part of the county is between 20 and 25% of the sellers are doing a price reduction. Here's overbidding. So where's overbidding going on? Well, it looks like it's going on in Cupertino and Sunnyvale, and then a little bit up on the San Mateo County coast and the island of Alameda, as well as the city of Berkeley. A lot of areas are blue in color, and which is less overbidding than normal. 99% of overbidding, 99%. Now, this is the average overbid. So even though the overbidding, I think in Milpitas was 99%, it's still 2.5% overbid. So it's less overbidding than you would expect, but it's still respectable. I mean, 2.5% would be $50,000 on a $2 million home. And then in the negative direction, look at San Mateo County coast. Buyers are going in 3% below the seller's ask price on average, which is pretty significant. And in Pleasanton, 1.8%, almost 2% below the seller's ask price. There's the frequency of overbidding. You can see frequency is less common now than it used to be, but the central part of the expensive areas of the Silicon Valley right now have actually more overbidding than normal. Basically 110% to 130% more overbidding than typical. So 10 to 30% more overbidding than normal. But the outlying more affordable areas have less overbidding. This is the frequency of overbidding. So how common is overbidding? You can see in Cupertino, 82% of the buyers overbid in that area, in that micro market area. And you go to the San Mateo County coast and it's only 11%. So you're going from 11% to 80%. So huge swings. And that's why micro market data is important. Countywide, they're all right around 60%, but that 60% again makes up a big difference, anywhere from 11% to 72%, 27% to 84%, and 38% to 82%. So wide range to come out with an average number that looks reasonable. This is appreciation. You can see the moderate commute areas have had the most appreciation, and I believe that's directly related to pandemic. We used to see Livermore lit up bright red. As remote working is becoming more restrictive, people are again favoring the areas with moderate commutes, longer than they were used to tolerate, but shorter than they were tolerating when remote working was more normal. Up along the San Mateo County, where there was a huge premium paid for being close to work, that premium has decreased, which has reduced the amount of appreciation. Now we're looking at the sold price. And instead of looking at just the median, I look at the low sold price and the high sold price. The low is the 10 percentile. So only 10% of the homes sell below that number. The high is the 90%, so only 10% sold above. So 80% of the homes are between the two numbers. So in Silicon Valley, 80% of the Silicon Valley single family homes sell between 850,000 and 3,750,000. And you can see each range. You go down to Los Altos, and you're selling between 3.3 million and $6.8 million is where the price range is. So you can quickly see your different price points. Fremont, that goes between 1.3 million and 3.2 million. And the median for Fremont right now is at 1.7. Here's a summary of what we just went over. We also did this at the beginning, so I'll just put it up there for a refresh your memory. And here's what we've been talking about, Silicon Valley Real Estate Marketplace. We have more details about Silicon Valley Real Estate Marketplace coming up. Then we finish up the last 7 minutes on the Greater Bay Area, 13 counties and 5 regions. This is how you can participate Saturday morning. Saturday morning, 9 o'clock, you can type in the green root URL and then 2025 for the year, or you can type in the longer Zoom meeting with the password built into it. If you want an archive, you can go to the YouTube channel, which is youtube.com/@ Silicon Valley Real Estate Market, or just type in the green root URL and you go to the archive. This is this current week's. This is the handout link for those that don't want to type in a secondary link. I am Richard Calhoun, real estate broker with Creekside Real, working with buyers or sellers here in Silicon Valley. Here's my contact information, email and phone number, text and voice, as well as email are fine. Appreciate likes and subscriptions. Let's move on to the rest of the Silicon Valley real estate market data. Here we're now comparing the 3 counties. We're looking at Santa Clara County in the blue, San Mateo County in the orange, and Alameda County in the gray. In rough terms, Alameda County has returned the most inventory and is basically at normal levels. San Mateo County actually exceeded its previous record. You can see we crossed 600 for the first time and is at its record levels. Santa Clara County is still lacking inventory. Offers accepted, you can see that Santa Clara and Alameda County are right on top of one another. I actually can't see Alameda County. I think they're both right very close to 800. And then San Mateo County is about 450 offers accepted in the last 5 weeks. Here is days of unsold inventory. Santa Clara County has the fastest turnover rate. San Mateo County is close on our tail at 41 days. And then Alameda County is at 54 days. Marketing time, all 3 counties are very close together. I mean, if I was to read this, it would be Santa Clara at 27, San Mateo at 28, and Alameda County at 29 days for 3 out of 4 sellers. So basically all 3 counties are selling, their 3 out of 4 sellers are selling in 4 weeks. That's a very reasonable marketplace. In fact, I would probably classify it as a fast marketplace. Price reductions, San Mateo County right now is taking the most price reductions. They're fairly close together at 1.5%. Alameda County is taking the least amount of price reductions at about 1.3%. It's only 0.2% change, fluctuates between the two. You can see they move together pretty well in unison. Here's the frequency of price reductions. So pretty common. So it actually looks like Santa Clara County may be doing the most price reduction right now with 1 in 5 at 20%, and San Mateo and Alameda County are tied right at 18% of the sellers are doing a price reduction. Alameda County is getting the largest amount of overbidding at 6.75% overbid. San Mateo County is next at 4.5% overbid, and Santa Clara County is getting the least amount of overbidding at about 3.75% overbid over the seller's ask price. Here's the frequency of overbidding. Again, all 3 counties are very close together. We don't normally see this. You know, if you come back here, you can have way more separation. We have been very close together the last year. We're right now between Alameda County is the least frequent at 59%, and Santa Clara County is the most frequent at 62% overbid. Here's the long-term appreciation. Santa Clara County is doing the best at just over 100% appreciation. San Mateo County is in second place at just over 80% appreciation, and Alameda County is right around 70% appreciation. And that's since 2015, the last 9 months of 2015. Here's your median sold price. This is based on log paper. You can see the most expensive region right now is San Mateo County. I would call it about, and it's hard to guess on log paper, maybe 2,050,000. Santa Clara County is at second at about 1950, and the most affordable region is Alameda at about 1250. On regular paper, easier to read the numbers. Santa Clara County is 1950. Santa Mateo looks like it's 2100. And Alameda County is about 1275. Here's estimated payments using the national number for high balance conforming loans. If you go simply jumbo rate, you're about 5/8% lower interest rate, which would drop your payments. And also, if you have money in stock that you can transfer to the lender's affiliated stock brokerage, you get relationship pricing that's even lower than that 5/8% savings. So these payments are acknowledgably on the high side, but it gives you an idea of what's happening with the impact of interest rates. Interest rates can double and the payments don't go up very much. In fact, we can go back and see that. Your payments were down here around 5,500 and interest rates basically doubled and payments only went up to about 9,500. That's because as the interest rates go up, the amount of money that goes to interest goes up, but the amount of money that goes to principal goes down because the last years, because of compounding, that huge extra money that's going towards, used to be going towards interest, pays the loan off more rapidly. So it's not a one-to-one relationship. Also, property tax at 1%, 1.25% is pretty significant and it remains fixed. And insurance is not dependent on interest rates. Here now we're looking at three distributions. The first one is marketing time. So here you start off with the 50 percentile, the median time. And the reason I don't go any further is the data is already pretty compressed over here. I track the 75th percentile, which is right through here. You go all the way up to the 90th percentile. The dotted line is what we're going to start off with, which was last year. The purple is this year. Notice how the two lines are actually fairly close together. Let's step through and we'll go 1 week at a time for 5 weeks, and then we jump 2 weeks at a time, and then 1 week at a time. You can see the market's normally slowing down at this time of the year, where it's been a gradual climb. That's the peak of the marketplace right here on December 27th. Then the market starts improving a little bit. Now it starts improving more. Notice how steep the incline is here. That's an improving marketplace. See how it's flattened out? That's already a cooling off marketplace. Now you can see it stepping up already. And it's stepping up. So the peak of the marketplace is very short-lived right after the first of the year. You came up. Now, again, we're going to hit a peak right about there, I think. And now you're going to cool, right? I guess I'm going out to peak. I'm not sure I caught that right. And then you cooled off. And now you're basically a plateau. And again, you can see that this year is a little bit cooler, especially up on the longer periods of time up here. Looking at large price reductions, this is large because this is the 97.5 percentile. The lowest I go is 82.5 percentile. And you can see the reason for that is a lot of lines are already at 100%, which is no price reductions. Now, the purple line, I could have gone out more because you're still taking a 2.5% price reduction here, but I'm trying to put out the most useful information. You can see that the purple line is quite a bit cooler than just a year ago. So here there's a big difference with people taking larger price reductions. Stepping through, not sure why this isn't stepping through automatically. I'll step through manually. That's about the peak. Now you're rapidly improving. And that was the valley, actually. There's the peak on February 21st. Now sellers are already taking less price reductions. Keep going down, cooling. And that might be another valley. And now you're stepping up a little bit and not really moving. Now you're improving a little bit, improving. And now you got the year separation. So you can see that this year is quite a bit cooler, quite a bit larger price reductions than last year. Here's the buyer overbidding. You can see that there's less overbidding on the purple line than there was just last year. We'll step through and hopefully it will work. Yeah, and this one's working. So fairly stable. Now you're starting to cool off at the end of the year. There's a lag time. Remember, this is about 4 to 6 weeks. That's the coolest we got right there. Even though there's cooler lines, you're already slowing, heating up. There's the peak of the marketplace on March the 8th and March the 22nd, April the 5th. Now you're cooling off by April the 16th, and now you're already going down. And that was April the 19th. And if you go back 4 weeks on that, you're back mid-March, the market's already cooling off. That was the value of the marketplace, the coolest. Now you can see it's heating up a little bit. And here again, you can see that the purple line, the current data, is quite a bit cooler than we were just 1 year ago. And that's the buyer overbidding. Now here's a table of offers. You can see that we were doing fairly poorly. We were the 24th out of 25 years, so we're second worst year out of the last 9. We actually improved to 3 out, the 7th worst out of the last 10 and 21st worst out of the last 25. We've now gone back the other direction and gone down a little bit. We're now the 8th worst, and the raw numbers are here. You're 2050 right now. You can see that the years that were worse are 18, 20, and 1832. So you have 2023 and 2022 that were worse by about 225 listings, so by 10%. So we're doing quite a bit better, but we're also doing quite a bit less than we were just last year. And this number is going to tend to decrease as escrows fail. So this 2216 could become lower than the 2206 and likely will. The 2149 is not likely to get lower than these two. So this 7 will probably get reverted to become an 8. I'm not seeing any others that are close enough to probably disappear. So this 7 will probably become an 8 next week. But the concept here is we're missing that marketplace. We're doing fairly low volume of sales, but the market's in balance, and imbalance is more important for a buyer and seller, for the consumer. Here's the actual numbers for either Silicon Valley, Santa Clara County, San Mateo, or Alameda Counties. You can pick the metric you like most. I highlight days unsold inventory because I believe that's an important number. You can see the numbers from last week are all higher. That's a slowing down in the marketplace. I group and highlight the 3 different days on marketplace. You have median, average, and the one I like to use, the 75th percentile. And there's 2 different appreciations on here. There's appreciation since the pandemic, which is interesting. Silicon Valley's gone up 42% since the pandemic, and Alameda County's only gone up 26%. And you also have the price appreciation since 2015, where Santa Clara County's gone up 103% and Alameda County's gone up 71%. You have to subtract off a 1 from the numbers displayed because of the original purchase price. With that, we're moving on to the Greater Bay Area. We look at 13 counties and 5 regions. We've been talking about Silicon Valley in length. I grouped San Francisco and Marin together. We call it the cities. North Bay, the 4 counties of Sonoma, Napa, Solano, and Contra Costa. Central Valley is San Joaquin and Sacramento, and Santa Cruz and Monterey make up the Central Coast. Here's your active inventory. You can see active inventory in all 5 regions is going down, which is less inventory, which is typical for this time of the year. This is number of offers accepted. Look at the large increase in North Bay and a significant increase in the cities. Silicon Valley has gone the other direction and has gone down. Central Valley and Central Coast are just slightly increasing. So Silicon Valley is really going in the other direction from the other regions. Unsold inventory, the turnover rate, Silicon Valley is normally the absolute fastest. The cities has improved dramatically in the last several weeks, about the last 4 weeks, and it's now right neck and neck with Silicon Valley. The other 3 regions are up here around 80 days, much slower, but 4 out of the 5 regions have been improving, decreasing the days to sell their inventory, and Silicon Valley has actually been increasing. So it's interesting that, again, Silicon Valley is going in a different direction. Here's marketing time. Silicon Valley has U-turned and gone up, but it's the fastest marketing time at about 28 days. The U-turn in the cities is much greater and at 42 days. Central Valley has just been climbing more or less at 62 days. And then you have the Central Coast at 75 days. And the longest marketing time is the North Bay at 78 days. That's 11 weeks. So you go from 11 weeks in North Bay down to Silicon Valley with 4 weeks. Here's the ask price reductions. Look at Central Coast, taking the most price reductions at 4% down. And this is average. North Bay is at 2.5% down. Central Coast is about 2.25%. Cities is about 1.5%. And Silicon Valley is the least price reductions at about 1.4% price reduction. Here's the frequency of sellers' price reductions. You can see they're all increasing. Silicon Valley has the least price reductions at about 18%. Cities is about, actually you can call it 19%. Cities at 20%. And then the other 3 are very close together at about 40%. So almost 4 out of 10, 2 out of 5 sellers are doing a price reduction. This is overbidding. You can see that Silicon Valley has been increasing, but the cities area, San Francisco Marin, has a much higher rate of price overbidding, almost at 9%. Silicon Valley is at 5%. Then the other 3 regions being the North Bay, right at ask price. Central Valley is taking 1% reduction when the buyers are coming in with their offer, and the Central Coast is taking a 2% price reduction. So it's more common there for buyers to go in under the seller's ask price and over, like it is in Silicon Valley. This is the frequency of overbidding. Cities and Silicon Valley is right at about 60% of the sellers getting overbid. So that's 3 out of 5 sellers. Then you drop down to North Bay at about the third, 36% of the sellers getting more than their ask price. Central Valley is only at 30%, and Central Coast is at 25% of the sellers getting more than their ask price. Here's the long-term appreciation. You can see that before the pandemic, all 5 regions behaved fairly similarly. You hit the pandemic, and very quickly, San Francisco and Marin fell out to the bottom. Right now, you have San Francisco and Marin still at the bottom, then North Bay, then it's a 3-way tie with Central Valley, Central Coast, and Silicon Valley having the most appreciation, right around 85% of the appreciation. Here's the median sold price. The most expensive is the cities. You can see that they're basically right at that flat plateau. Even the purple line, when you look at just the purple data, you can see it's basically been flat for the last 3.5 years. The blue line, the Central Coast, is going right through their pricing. North Bay, same concept, basically all the way back to the 2022 price point, and the Central Valley the same way. And when I say the 22 price point, it was actually sometime in 2021. So the pricing model that I threw up there, where you have 7.5 years of it, I think it was 12.1% appreciation, and then the last 3.5 years of being flat, is fairly accurate when you start looking at each of the 5 regions. And again, this is the monthly payments, assuming an 8% loan, using the Fannie Mae high balance conforming loan for the national average. You can get better interest rates by going jumbo money, which most people in Silicon Valley would be doing. And with that, we're the raw numbers. Let me see if anyone's got any questions. I'm not seeing any unmuted mics. Is there any questions before I disconnect for the week? See you next week at 9 o'clock on Saturday morning. Take care.